in 1973, when Graham last revised The Intelligent Investor, the annual transaction rate of the New York Stock Exchange was 20%, which means an average shareholder held the stock for about 5 years before selling it. By 2002, the transaction rate had decreased by 105%, with a holding period of only 11.4 months. In 1973, the average mutual fund held stocks for about 3 years. By 2002, the share ownership period had come down to just 10.9 months. It seems mutual fund managers were studying their shares so that they could learn that they should not have bought them in the first place. Then they were immediately sold and everyone started working. Even the most respected money management firms were in trouble. At the beginning of 1995, Fidelity Magellan, which was then the world's largest mutual fund, had 42.5% of its assets in technology stocks with its manager Jeffrey Vinik. Vinik had announced that most of his shareholders had invested in the fund for goals that were many years away. I think their purpose is the same as mine, and they believe, as I do, that the long-term perspective is the best. But 6 months after writing those high ideals, Vinik sold almost all technology stocks and sold shares worth about $19 billion in those 8 crazy weeks. By 1999, Fidelity's discount brokerage division was giving its customers the opportunity to trade anywhere at any time using Palm handheld computers, which was in perfect harmony with the firm's new slogan, "Every click counts." Wall Street created online trading systems to make instant money. The online branch of the Morgan Stanley firm, Discover Brokerage, ran a TV ad where a dirty tow truck driver picks up a rich-looking executive. Seeing a picture of a tropical beach on his dashboard, the executive asks, "Vacation?" The driver replies, "That's my home." "Okay." The man in the suit says, "It looks like an island." The driver replies, "Technically, it's a country." The ad goes on. Online trading says it requires neither work nor any thought.
A TV ad for the online broker Ameritrade shows 2 housewives returning from jogging. One logs into her computer, clicks the mouse a few times, and excitedly says, "I think I've just earned about $1,700. In a TV ad for the Waterhouse brokerage firm, basketball coach Phil Jackson is asked, "Do you know anything about it?" His answer was, "I'm going to make it right now." They didn't know anything about the other team, but said, "I'm ready to play now." By 1999, at least 6 million people were trading online, and 1/10 of them were day trading, using the internet to buy and sell stocks quickly. Everyone, like Shobi, a 25-year-old former restaurant waiter in Queens, New York, was stocking live quotations. Before, he said, "I was investing for the long term, and I found out that it was not smart." Now he traded shares 10 times a day and hoped to earn $1 million in a year. Barbara Streisand told Fortune in an interview, "I can't stand to see red in my profit or loss column." She says, "I am a Taurus, so I react to red. If I see red, I sell my stock." Due to continuous data entry through Nike stores, kitchens, cafes, taxicabs, and trucks, stocks, financial websites, and financial TV shows, the stock market has become a non-stop national video game. The public is much more than before. It was just a blip running on a TV or computer screen. On December 20, 1999, Juno Online Services started a groundbreaking business plan which was sure to cause them some loss. Juno announced that from now on, they would provide all their retail services for free via email and would not charge for internet access, spending millions of dollars on advertising and in advertising the next year. After this announcement from the corporate hierarchy, Juno shares rose from $16.375 to $66.75 in 2 days.
Why was it necessary to learn why the business was profitable, or what kind of product or service the company produced, or how its management was, or what the company's name was? What you need to know about stocks is that they had attractive codes: CBLT, INKDT, PCLN, TGLO, VRSN, WBVN. This way, you can buy them quickly without any 2-second delay. At the end of 1998, a small, rare business maintenance company, Temco Services stock almost tripled in minutes on record high volume, because in a strange form of financial dyslexia, thousands of traders bought Temco after forgetting their ticker symbol TMCO for Ticker Master. This internet stock started trading publicly for the first time. Oscar Wilde joked that a dull person knows all the prices and knows nothing. According to this definition, the stock market is always angry, because at the end of the 1990s, it shocked Oscar. A company could double the stock in value, even though its value had become completely unpredictable. At the end of 1998, a CIBC Oppenheimer analyst, Henry Blodgett, warned that a comparison of evaluation with all internet stocks is clearly more art than science. Then, referring to the potential for future growth, he announced his price target for Amazon.com at $150 to $400. That day, Amazon grew by 19%, and despite Blodgett's opposition, their value was an almost one-year-old estimate that had crossed $400 in just 3 weeks. A year later, Paine-Webber analyst Walter Piesik predicted that Qualcomm stock would reach $1,000 per share in the next 12 months. That year, the stock had already grown by 1,842%, and that day it grew by 31%, reaching $669 per share.
From formula to failure. Though trading is fast-paced, it's not the only form of speculation. Over the last decade, formulaic speculation has grown, one after another, and all of them have violated Graham's rule regarding the difference between investment and speculation. Here are some of the popular formulas that failed from the start. The January effect, a cleaner cash flow. The tendency of small shares to make big profits at the end of the year was widely discussed in academic papers and popular books published in the 1980s. These studies showed that if you bought small-cap stocks in the fourth quarter of December and held them until January, you'd get a return of 5 to 10%, which surprised many experts. However, if it were so easy, everyone would have heard about it. Many people did, and their opportunity slipped away. What caused the January jump? First, many investors could lower their tax bills by selling their weak shares at a loss at the end of the year. Second, professional fund managers become more cautious as the year ends, as they want to protect their performance. This makes them reluctant to buy falling stocks, and if a low-performing stock is small and obscure, a fund manager would also be ambitious to show it on the annual list of holdings. All these factors turn small stocks into a momentary bargain. When the tax-driven selling ends in January, they usually return to making strong and quick profits.
The January effect didn't last long and has weakened. According to William Swant, a finance professor at the University of Rochester, if you bought small shares at the end of December and sold them at the beginning of January, you would have profited from the market by 4.4 to 8.5% from 1980 to 1989 and 5.8% from 1990 to 2000. As more people learned about the January effect, more traders bought small shares in December, causing them to trade less and thus reducing their returns. Additionally, the total cost of buying and selling the January effect could increase your investment by up to 8%. Unfortunately, your profit from the January effect goes away when you pay your broker. Just do what works. In 1996, an obscure fund manager named James O'Shaughnessy published a book titled What Works on Wall Street. In it, he argued that investors could get much better returns than the market. O'Shaughnessy made a big claim. He said, from 1950 to 1996, you could earn $8,074,504 from $10,000, more than 10 times the market. This means an average annual return of 18.2%, with a maximum one-year return achieved by buying a basket of 50 shares with 5 consecutive years of earnings and shares valued at less than 1.5 times their corporate revenue. Part 1. The Misconception Trap. Wall Street had a different version for O'Shaughnessy. O'Shaughnessy was awarded U.S. Patent number 5978778 for his self-created strategy and launched a group of 4 mutual funds based on his research. By the late 1990s, these funds had raised more than $175 million from the public. And in his annual letter to shareholders, O'Shaughnessy said, "As always, I hope we can achieve our long-term goals together." But what seemed to work on Wall Street stopped working right after O'Shaughnessy promoted it. 2 of his funds sank so badly that they were closed in early 2000. In June 2000, he saved himself by leaving his clients to other new managers,
coming close to his new long-term goal.
The Foolish Four. In the mid-1990s, the Motley Fool website and several books promoted a strategy called the Foolish Four. According to Motley Fool, it was possible to earn more than your mutual fund over the last 25 years by spending just 15 minutes on your annual investment plan. The best part was that this strategy had minimal risk. All you had to do was 1. Select the 5 stocks in the Dow Jones Industrial Average with the lowest price and the highest dividend. 2. Drop the lowest priced stock. 3. Put 40% of your money into the second lowest priced stock. 4. Put 20% into each of the remaining 3 stocks. 5. After 1 year, short the Dow Jones again and reset the portfolio according to steps 1 to 4. 6. Keep doing this until you get rich. Within 25 years, the Motley Fool claimed that this strategy had raised a significant annual income of 10.1%. They said a $20,000 investment in the Foolish Four would turn into $1,791,000 over the next 2 decades. Let's assume this policy could meet Graham's definition of investment. First, such deep analysis might leave out stocks with the most attractive prices and dividends, but only those with those 4 qualities. Second, putting 40% of your money into just one stock could be a minimal risk. Third, how diversified can a portfolio of just 4 stocks be in protecting capital? In short, it was one of the most popular stock-picking formulas. People were wrong with O'Shaughnessy. If you look at a lot of data for a long time, a lot of patterns will emerge. Due to singular or combined luck, many things will be common among companies that provide average stock returns. However, those factors cannot be used to predict future returns. In 2000, the 4 stocks of the Foolish Four, Caterpillar, Eastman Kodak, SBC, and General Motors, fell by 14%, while the Dow fell by only 4.7%.
These examples show that there is one thing on Wall Street that a bear market is never afraid of. All mechanical formulas are a kind of self-destructive process, like the law of diminishing returns. The reduction in income is due to 2 reasons. If the formula is based on a flow of random numbers, time proves that there was no basis in the first place. On the other hand, if the formula really worked in the past, like the January effect, the market pundits usually spoil it after it is promoted and destroy its ability to do so in the future. This reinforces Graham's warning that you should stay away from speculation. As an intelligent investor, you should keep a small part of your total portfolio as a crazy money account. For most of us, no more than 10% of total assets should be at risk. Never let your speculative thinking enter your investment activities, and don't keep more than 10% of your assets in your crazy money account, whatever happens. The instinct to gamble is a part of human nature, so for most people, trying to suppress it is useless, but you have to limit and restrain it. It is the best way to ensure that you never fool yourself into speculating with confused investment. Part 2. Investors and Inflation. Many years ago, it took 2 people to carry a bag of groceries bought with $10. But today, $10 buys so little that a 5-year-old can carry it. Who cares about the inflation rate? Between 1997 and 2002, the average price increase for goods and services was less than 2.2%, and economists believe the actual rate may have been higher. For example, the prices of computers and household electronics have decreased, but the quality of these products has increased, which means consumers are getting better value for their money.
In recent years, the actual annual inflation rate in the U.S. was about 1%. Scholars declared that inflation was virtually dead. Money illusion is another reason to ignore the importance of inflation. If your salary increases by 2% in 1 year and inflation is 4%, you have actually taken a pay cut of about 2%. At that moment, you will feel better than if you had a 0% pay cut during a period of zero inflation, even though both changes put you in virtually the same situation. As long as the nominal or total change is positive, we view it as a good thing, even if the result after inflation is negative. Where big numbers make us feel good, inflation secretly erodes those big numbers. Instead of advertising, inflation takes away our wealth. That's why it's not so easy to ignore inflation. To measure the success of your investments, it is important to consider how much you earn, not how much you save after inflation. The bottom line is that intelligent investors should always be wary of unpublicized and underestimated events. Here are 3 good reasons why inflation is not yet extinct. 1. Between 1973 and 1982, the United States experienced one of the most painful periods of inflation in its history. During this time, prices more than doubled, according to the Consumer Price Index, which crippled the economy. The cost of goods and services that were $100 at the beginning of 1973 became $230 by the end of 1982, dropping the dollar's value to below 45 cents. 2. In the global markets since 1960, 69% of countries have faced an annual inflation rate of 25% or more in at least 1 year. 3. Rising prices allowed Uncle Sam to pay off his debts with cheap dollars due to inflation. Completely eliminating inflation is against the economic interests of a government that regularly borrows money. Protection against inflation. What can an intelligent investor do to protect against inflation? The ideal answer is to buy stocks, but like a common answer, it is not entirely true. When the prices of consumer goods and services went down, stock returns were terrible, including a loss of up to 43% of market value. Stocks also sink when inflation is at 6%. You can do something besides stocks to strengthen your defense against inflation. When Graham last wrote, 2 inflation-fighting investments became widely available to investors.
Real estate investment trusts, or REITs. These are companies that earn and collect rent from commercial and residential properties. TIPS, Treasury Inflation-Protected Securities. First issued in 1997, their value automatically increases when inflation rises. When the value of your TIPS bond increases due to rising inflation, the Internal Revenue Service considers it taxable income, even if it is purely a paper gain. TIPS are best suited for tax-deferred retirement accounts like an IRA. You can buy TIPS directly from the U.S. government or through low-cost mutual funds such as Vanguard Inflation-Protected Securities or Fidelity Inflation-Protected Bond Fund. It is a wise way to allocate at least 10% of your retirement fund to TIPS. Part 3. The History of the Stock Market. If you don't know where you are going, you should be careful because you might not get there. In this chapter, Graham explains how predictions work. He uses his foresight to show how to profit from the market even during the catastrophic period of 1973 to 74. During this time, American stocks lost 37% of their value, an effect that lasted for more than 2 decades. The core of Graham's argument is that intelligent investors should not predict the future based on the past. Unfortunately, this was a mistake made by a series of bullish books in the 1990s, such as Jeremy Siegel's Stocks for the Long Run, 1994, and James Glassman and Kevin Hassett's Dow 36,000. These forecasters argued that since stocks have increased by an average of 7% annually after inflation since 1802, they concluded that investors should expect even greater growth in the future. Some stocks had also always been ahead in any period of at least 30 years. At the beginning of 1999 and 2000, there were balloons everywhere. On December 7, 1999, Kevin Landis, a portfolio manager for First Hand Mutual Fund, appeared on CNN's Moneyline. When asked how much wireless telecom stocks would gain, he had one answer. It's not a fad, it's a complete development. Look at the full value of the development. It's big.
On January 18, 2000,
Freud announced in the Wall Street Journal, "It's a new world order." He said that people give up on the right companies because their share prices are too high, and that is the biggest mistake an investor can make. In April 2000, Jeffrey Applegate asked in Businessweek, "Is the stock market more at risk today than it was 2 years ago because prices are higher?" His answer was no, but the answer is yes, it always was and always will be. Like an angry Greek god, the stock market crushed all those who believed that the high returns of the late 1990s were some kind of divine blessing. Look at what happened to the predictions made by Landis, Froelich, and Applegate. From 2000 to 2002, the most stable of Landis's favorite wireless stocks, Nokia, fell by 67%, while the worst, Windstar Communication, fell by 99.9%. Froelich's favorite stocks, Cisco Systems and Motorola, fell by more than 70% by the end of 2002. Graham's general questions for these types of stocks. In the form of permanent protection, Graham asks intelligent investors to ask some simple and concise questions. Why will the future return of a stock always be equal to its previous return? When every investor believes that stocks are guaranteed to make money in the long term, won't there be a huge drop in the market? Once that happens, how will it be possible to achieve high returns in the future? Graham's answers are always rooted in logic and common sense. The value of any investment should always be a function of the price paid for it. At the end of the 1990s, inflation was gone, corporate profits were growing rapidly, and there was peace in most parts of the world. But this did not mean that stocks were worth buying at any price. Focusing on recent market reports, Graham warns that it is a strange and dangerous conclusion to assume that a similar spectacular result can be expected for common stocks in the future. From 1995 to 1999, the market grew by 20%, which created unprecedented optimism among stock buyers in American history. In mid-1998, investors surveyed by the Gallup organization for Payne Weber brokerage firm expected their portfolios to earn an average of 13% in the next year. At the beginning of 2000, their average expected return was above 18%. The principle of contrarianism. Graham's warning in this chapter is simple. According to the principle of contrarianism, overly enthusiastic investors who have been in the stock market for a long time may be proven wrong in a short period. On March 24, 2000, the total value of the American stock market reached $14.75 trillion. On October 9, 2002, just 30 months later, the total American stock market fell by $7.34 trillion, or 50.2%. During this time, many market scholars forecast flat or even negative market returns annually or even for the next decade. At this point, Graham asks a simple question: why do intelligent investors trust experts even after they are finally proven wrong? According to Graham's method, the performance of the stock market depends on 3 factors. 1. Real growth, the growth of companies' earnings and dividends. 2. Inflationary growth, the general increase in prices in the economy. 3. Speculative growth or decline, the decrease or increase in people's hunger for investment. The annual average growth of long-term corporate earnings per share is 1.5% to 2%. Since the beginning of 2003, inflation has been running at about 2.4% annually. Dividends on stocks were 1.9%. This means that you can reasonably expect a 6% return from stocks. If people become greedy again and start buying stocks, that speculative fever will temporarily drive higher returns. If instead investors are full of fear, like in the 1930s and 1970s, the stock returns will be temporarily lower. Professor Robert Shiller of Yale University believes that Graham has provided his perspective on valuation. By scanning historical records, Shiller has shown that when the current price of the S&P 500 stock index relative to the 10-year average corporate profit goes above 20, the market usually gives poor returns.
When it falls below 10, stocks typically generate profits.
At the beginning of 2003, according to Shiller's math, stock prices were about 22.8 times the average inflation-adjusted earnings of the last decade, which is still risky, but it has come down from the frenzied level of 44.2 times earnings in December 1999. So, from the valuation level at the beginning of 2003, the stock market sometimes performed very well in the next 10 years, sometimes poorly, and was in a confusing state the rest of the time. I think Graham would divide the difference between the lowest and highest returns and estimate that stocks will earn about 6% per year or 4% after inflation in the next decade. 6% is nothing compared to the 1990s, but it is better than the profits that are likely to be generated from bonds, and is a sufficient reason for most investors as part of a diversified portfolio. But Graham's view is different. When it comes to predicting future stock returns, you can rely on only one thing: that you will probably be wrong. According to Graham, being humble about your ability will save you from taking excessive risks on a view of the future that might turn out to be wrong.
The future can be proven wrong, so by all means, you should lower your expectations. But remember, don't let your emotions get disappointed. For an intelligent investor, hope is always an eternal spring. The worse the future looks in the financial markets, the better it is. Once a pessimistic British novelist and essayist G.K. Chesterton was told, "Blessed are those who expect nothing, for they will not be disappointed." Chesterton's revision was, "Blessed are those who expect nothing, for they will enjoy everything." Thank you. Have a good day. How aggressive should your portfolio be? Graham says, what kind of investor are you, and on what kind of investment are you less dependent? Here are 2 ways to be an intelligent investor. Firstly, by creating a mix of stocks, bonds, or mutual funds, and investing through continuous research, selection, and monitoring. Secondly, by creating a permanent portfolio that runs on autopilot and doesn't require extra effort. Graham's first approach is active, or enterprising, which takes a lot of time and energy.